Preparing for taxes is a great topic, but really something you should be thinking about all year long. I find it interesting. People use coupons in order to save, a few percent off things here and there. They use the rewards credit card. They're talking about that across the hall in order to save 3%. Well, taxes are like half. And so, doing something right for taxes really, really is much more relevant. I would say the more successful you are, the more you are concerned about this. And so I'm assuming the group of people that are here today are probably the more successful stores that appreciate these things. I frequently ask my clients, what's your biggest cost in life? And people start answering things, housing or education or health. The truth is, most business owners pay more than half of their income in taxes. So your taxes are probably more than everything else combined. So they really are big and deserve time and attention. Wow. Anyway, I'm Bob Saunders. I'm the founder of a local CPA firm, Westfield CPAs. We have decades of experience helping people do things like this. I'm also a Todd's father. My father was a CPA, and I have a son who's a CPA, and then we have Todd, who has all the personality from all of us. I have a lot of content, so I'm going to get into it. Look, professionals always talk with a disclaimer, don't sue me, but really don't just glaze your eyes over it. I'm going to talk from the hip. I'm going to try to answer your questions, and I'm not perfect. The universe of tax questions is so enormous, and it really applies differently to different people that disclaimer really is relevant. And so I'm going to try to give you topics to talk to your tax person about so that they can give you the official advice. But really, you have to take everything with a grain of salt because it applies to different people differently. 2021 has been a unique year. For the flooring industry, it's kind of amazing to me how when COVID began, we had so much uncertainty and heartache. No one really knew where it was going to be, and we assumed everything was going to die. But it evolved into one of the best opportunities and record-breaking sales for people in the flooring industry. Record-breaking sales led to record-breaking profits and also led to record-breaking taxes. There are opportunities that you have now that will not be available in January that you should take advantage of. First step, something I'd like to help people understand here today, is how to deal with CPAs. CPAs are clearly not known for their wonderful personalities. And that COVID has really been very cruel to CPAs. It's really resulted in a shortage of talent. I know you have a shortage of talent with installers. For CPAs, we previous to COVID, we had a shortage of talent, and now it's become even worse. Many of us have been in triage mode this whole time during COVID, really working harder than ever, struggling to get through our day. And overall, we're pretty cranky. So you have to appreciate that coming in. And accountants really have run out of time to proactively reach out to clients. And they deserve it. And so, if they don't, okay, it sucks that they're not doing their job, but you're the one that hurts from it. So you're the one that needs to proactively reach out to them. This funny little video you're watching is exactly when you don't want to call your accountant. A great tip I will tell you about dealing with your CPA is to stay away from them when they look like this. And it's predictable. If you're the type of person who brings your stuff in late for an accountant to do, they're not going to do as good a job as if you plan with them during the year and then come to them early. And so if you are one of those people, suck it up, pay money, go on extension, and wait till May. You will get a much better value and you will get much more thought in doing that. Does everyone here use an accounting firm? Yes? Okay. Look, inside your industry, you know things that the consumer doesn't know. Inside my industry, I know that as well. Let me give you the big one, though. Many accounting firms, local firms, are glorified form filling out firms. And they may fill out forms well, but all they're doing is filling out forms for you. Other firms, like ours, are thoughtful and planning and intelligent based. The forms are like a byproduct of what we do, but not our main product. And you have to decide for yourself whether you want to be with a company that just fills out forms or a company that provides thought. And I would tell you, there's really nothing in between, and firms are really one or the other. Most people, most individuals really need a forms filling out company. But if you're a business, you have to identify if they give you value beyond filling out forms. And if not, you should be willing to do something about it. Your expectations for a CPA firm is that you make a profit on the money you spend on them. I know that might sound odd, but look, your accounting records should be a useful tool, not just to do your tax return. Money you spend in an account, I'm going to say it again, you should profit on that. Otherwise, you shouldn't use them. A few more things on dealing with CPAs. Our product is our time. Do you stand around giving away free carpet to people? Well, when we're really busy, we really don't like chit-chatting. It's difficult because that's all I've got. And so, there's people, I may have known from college, and I do their tax return, and they come in during tax season and want to chit-chat for an hour. That's like stealing from me. That's no different than someone coming to you and doing it. So you have to kind of be a little conscious of that and chit-chat in May, June, July, August, September, plenty of time for that. But it's that time really will take away from the time they have to work on what they need to do for you. Because most of us really work every minute we're awake. And honestly, if I had an extra 15 minutes that week, I'd probably spend it with my wife or my son. And I'd rather spend that 15 minutes actually doing the work at that point for you. Another tip in using an accountant would be close the gap in the time between they start working on your information and they finish it. Can you imagine spreading out doing someone's living room floor over the course of a month? They have a question, where should we move this? Well, if you don't get back to the customer doesn't get back to them for 2 weeks, and they forget, it takes more time. Most accountants bill based on time. Close that gap. If they ask you questions, and if they ask you 4 questions, answer 4 questions as soon as you can. It's frustrating to us, and we charge our clients a lot more if they get back to us with one answer 3 weeks later and say, well, what else did you need? Because now we're starting over again, and we lose traction on what we're doing. So we can produce 2 identical products, identical results, and one of them can literally be 2 or 3 times as expensive as the other. And as an accountant, that breaks my heart. I don't want to charge 2 or 3 times as much. And so closing that time gap really, really is important. Another tip, hopefully the firm you deal with is more than one person. I will tell you that the one-person firm should not exist. There is so much knowledge, and I'm up here pretending to be an expert on all things, but the universe is so big that I need a dozen people behind me where we delegate different topics to. So hopefully all of you have the resources of using a firm greater than one. Even 3 or 4 is much better than 1. Assuming that's the case, the staff really is the first line of defense to talk to. You don't always have to talk to the partner or the owner because, believe it or not, the staff and the partner talk, and you'll get the right answer, and you shouldn't be afraid to do that. They're more available to you. It's sort of like when you go to the doctor's office. You can talk to the nurse or you can talk to the PA. You don't have to ask the doctor where to park. I'm going to give you the first thing you should remember. You have an action item that you should write down and you should do right now. You need to take it upon yourself to be proactive and not wait for them to call you because they're not probably going to. The time is already tight. You need to call them and ask them to set up a planning appointment now. We have 1 month available, and that's not much. We're busy, especially with Christmas and the holidays coming. But today, even while you're at this meeting, it's okay. I'm going to tell you what you're going to talk to them about. You need to set up a meeting to say, before it's too late, I'd like to make some plans and see if there's any strategies available to me. While your tax firm or your accounting firm, the tax guy, whoever, I'm going to use it interchangeably, while you hold them responsible to do a good job for you and to keep you out of trouble, the reality is it's your problem. If I make a mistake and you don't pay the right sales tax, you're the one that has to pay it. There's penalties. You can argue with me that I'm going to pay it, but the government's coming after you. And they're going to come after you for a long time back in history. You also have obligations to employees to save things for a long time. So this tip is a little more complicated, but you need to be self-sufficient from your accountants. If everyone at your accounting firm gets wiped off the map, you should be able to survive and move forward. In order to do that, you need your own records. So you need, and by the way, it's not good enough to say, oh, I can go online with the bank and get my stuff. That's just not true. You need 5 or 6 years worth of records. COVID extended the statute for these things. Your bank typically will have 2 years worth of your bank statements. You get audited, you need 4 or 5 years. So you need 5 years worth of general ledgers, bank and credit card statements, payroll records, sales tax records, and W-2s, and maybe a few more things. It is a project that you should do once a year. It'll take you a couple of hours, but you need an electronic file in PDF format of everything you have for each year. You need to go back for 5 years and do it. The other reason this is really good and important to have is that you can pivot. Your accounting firm isn't giving you the time you deserve. Be ready to move on. They don't deserve your business. There's so many cliches. The most common mistake in accounting firms is we just keep repeating what we did last year. In my industry, it's so easy to stand out just by thinking for a few minutes. Groundhog Day is like running an accounting firm. You know, why the accountant cross the road? Because he did that last year. You know, there's just no real reason why. Ask your professional in this meeting to stop, pause, and think about you. Ask him to pretend that you are a new possible client and look at my stuff and tell me, what would you do differently? What would he suggest? Can he do anything better than the old guy? No, he is the old guy. But if you haven't gotten any suggestions for a few years, there are some. And so put them at task for this. Don't be like Groundhog Day. That's the single most dangerous thing we do. We've had dramatic changes in our tax code in the last 4 years. They haven't stood still for a moment. Anyone that did a PPP loan with the ever-changing rules, honestly, that's what our lives are. And every time there's an election, people promise us more things. That changes our tax code. We use our tax code to regulate social behavior. We want, there used to be incentives to invest in gas and oil. Well, now they don't want us to do that. Now they want us to do solar. And then if you do too much of what they ask for, they think you're a villain for not paying tax. But things change all the time. So even your entity, I'm going to start at the very top. Your very existence needs to be reconsidered. Maybe not have to do it every year, but you should consider it. Income tax is only one of a lot of taxes you pay. Sometimes changing your entity doesn't save federal income tax. But we also pay Medicare, Social Security, net investment income tax, that's a new one from Obamacare, unemployment, disability, workers' comp, state taxes galore. We have a client in New Jersey. She did a lecture in California. I forgot her topic, and she received a $75 honorarium. She got a 1099 from California, and we did it right. We filed a California tax return showing her $75 of income. California billed her $800 for the privilege of being in their state because that's the fee they charge to anyone in their state that does business. Every state has these things. Whatever state you're in, there are special taxes in that state, and you need to consider all of these taxes in what entity you are. I'm from New Jersey. It's an ugly state from a tax perspective. We are what's called a gross income state, not a net income state. So, if you have a pension and you're deducting on your federal return, it's different on New Jersey. So everything is different. There are differences in how pensions are deducted, health insurance is deducted. New Jersey, for example, they lump together partnership income and they call it one thing. So if I have a stock in a partnership and I make money and a stock in my personal account and lose money, I only pay tax on the winners. I don't get to net them. So every state is different. You have to consider your entity for that. Obama, I'm going to pick on something fun here for a minute. When Obamacare was put in force, the Affordable Health Care Act, they added basically Medicare tax on top of all other income. So we used to pay it on earned income, and they added it to like interest dividends, capital gains, and things like that, rental income. But instead of them saying, you're going to pay Medicare tax, now called net investment income tax, on everything except what you're paying Medicare tax on, they tried to list the items, and they forgot some. I mean, it was obviously just written really, really poorly. I think it was Nancy Pelosi who said, if you want to know what's in the bill, you have to pass it first. I have one prop. It's my only favorite prop, though, by the way. What do accountants do for fun? I have Joe Biden's tax return. This really is his tax return. I'm not making this up. The year Joe Biden left office, he opened up a company called Celtic Capri Corp. He received $10 million in speeches. But it's in a corp. It's an S corp. So from that S corp, it had approximately $10 million of profit. How much salary did he take? Anyone guess? 5 million? 10 million? Come on, I'm supposed to be the boring one. Someone say something. How much do you think he took? Who knew that? He took $145,000. I'm really reading from his real return. Okay, you're wrong. It was $145,833. His S corp profit was $9,490,857. This didn't change his federal tax by a nickel. It probably didn't change his state tax by a nickel. What did it do, though? He avoided paying the Obamacare taxes on $9.5 million, which came to $500,000. I'm going to tell you something. This is unreasonable. So he had an S corp, and it's one of the rules for that. What he could have done was maybe paid himself $5 million. I don't think that if you warranted $10 million of speeches in the year, I could pay you less than $5 million. So reasonable compensation was needed. It wasn't done. Of course, the media doesn't talk about that at all. But this is a strategy. So if he were a sole proprietor, he would have paid $500,000 more in tax. If he were a partnership, he would have paid more than that. So these are things that you have to kind of think about. We're going to talk about a few items on their own. But then you have to go back and apply those items to how they work differently with different entities. Some of them we're going to talk about is this Trump 20% qualified business income deduction. Only pay tax on 80% of your income if you want to, with some planning. What's called, does everyone know what SALT means in tax slang? Okay, one accountant in the back. Let's hear it. State and local tax. He took away our state and local tax deduction. We have ways to get it back. I think they only put this slide in here so I can take a breath. I'm not sure why it's there. But let's get ready, because really this is where I'm going to give you some specifics, and these are the filler. This is what you're going to want to talk to your CPA about. You can ask me if he's a groundhog. You probably won't even know what you're talking about, because again, we're not known for our winning personalities. We're beyond PPP loans. Who here has gotten a PPP loan? Okay. How about PPP2? Okay. PPP2 means that your sales went below a certain threshold in order to achieve. Now, I can't give you everything. There are rules here that say that you're entitled to some of these things I'm talking about if your government shut you down or lost. I don't think that apply to most of you, so I'm going to do the common criteria. Your sales had to be down 50% in order to get PPP2. Who here got the employee retention credit? Who knows what I'm talking about? One in the back. Thank you. The government encouraged you to keep employees on. Now, I'm going to go back in history about this, and the reason it's important is you can still get it. It's not too late. In 2020, if you kept your employees on and you suffered a 50% decline in sales, I'm going to come back to how that's measured. Listen, one of my favorite things that I explain to people all the time, companies looking to hire an accountant. It's 3 people in the waiting room. First, a person comes in and they say to him, please tell me, what's 1 plus 2? The guy takes out his calculator, double checks it on his fingers. I am sure that's 3. Thank you very much. Next, please. Next person comes in. What's 2 plus 2? This guy's got one of those old Chinese things. He figures it out. He counts on his toes. 2 plus 2. I am certain that is 4. Thank you very much. Third accountant comes in. What's 1 plus 3? Accountant doesn't take anything out. No pencil, no paper, no nothing. He looks the guy in the eye and says, what would you like it to be? It really is true. We do have flexibility, and it can be what you want it to be. If you tell me, my sales were supposed to be down by 50% in order for me to qualify for this, and I was only down 48%, bullshit. Fix that. There is a way to fix that. It's just not true. Anyway, for 2020, if you had a 50% decline in sales, and it's complicated the way to define that, in the same quarter from 1 year prior. So in 2020 compared to 2019, you qualify for this credit. The credit was up to $5,000 per employee per quarter for all of 2020. Once you qualify, it's easier to qualify in the next quarter. So the next quarter, sales only had to be down by 20%. So you could have saved $20,000 per employee all year in 2020. It's not too late to go back and see if you qualify. Does everybody here have employees? I hope. Nobody? Okay, thank you. Just wanted to make sure you weren't all accountants. Each quarter, you fill out a form called a 941. Your payroll service does this for you. And it says, this was my gross wage. We held Social Security, federal unemployment, and this is how much we paid in, and this is what we owed. There's a line that appears on that form now that says, how much does the government owe you for employee retention credit? And you're entitled to get it. You have to amend those older forms, but it's not hard to do, and you can still get that money back today. Quarter by quarter, 50% of what you paid any employee, up to $5,000 per quarter. It was a little hard to qualify for with 50%, so people didn't pay attention to what happened in 21. In 21, they changed it to a 20% decline. And once you qualify for quarter 1, you get it for quarter 2 automatically, and you keep getting it through quarter 3, basically 1 quarter beyond when you don't qualify. And so you only need 1 quarter to qualify in order to get 2. So in 21, they made it even better. But there was so much going on and so many changes. I think a lot of people miss this. If your first quarter 2021 was 20% less in sales than your first quarter in 2019, and I think there's another You can look at more quarters than that to figure it out. Again, that's that accountant looking at what's 2 plus 2, and suffered a 20% decline. You can save 70%. They will refund. They will cut you a check. My slide should have been my check. Oh, actually, you know what? I'm the slide behind. I should have put up here the check that my firm received. We had our best year ever, but I qualified for 2 quarters because my first quarter, this one's kind of funny. My first quarter 21 compared to my first quarter of 19, we worked harder and we had more sales than ever. But the government didn't come out with the forms until April. So we did all the work. We just didn't bill it till April. So our first quarter of 21, and by the way, we knew this was here. Our first quarter of 21 was less than our first quarter of 19. Even though it was our best year ever, we qualified and we saved $7,000 per employee times the number of employees in our office, and we received a check for like $100,000. And that's great. It really is. They are literally printing money for you and I to have. Talking gross. That what? I would say we've done about 100 of these, and it is shocking how fast we got the money. I don't have many nice things to say about the IRS. I really don't. Something was wrong with the 941 you filed. I don't know if you filed it by hand. Listen, if you mail them a tax form, it's probably sitting in a trailer somewhere for a year or two. So you have to do things electronically. And did you call your accountant? And what'd they say? Wrong answer. So we have special access to the Internal Revenue Service. It's called Practitioner Hotline. And we can't always get through, but it's a lot better than 1-800-1040. And so what we do is we have a pile of things we need to talk to them about, and our support staff calls at 8 o'clock, and they call at 9. And once we get through, they allow us 5 clients to talk about, and it takes us a day or two. If you try hard enough, listen, where's my son here? Here's the career advice I always gave him and his friends. Most people suck. All you have to do is try. You're ahead of 90% of them. So all you have to do is try. So we accumulate them and we try, and when we get through, we go over them. And honestly, they get resolved fast. We have problems with forms and trailers still. But, and the IRS, can you imagine this? November 20th, the IRS is shutting down e-services, so we can no longer electronically file anything until mid-February. That's every year. But they think, well, you should have filed already. And so for a lot of these amended things, we can't. But you can do it. This really is free money. Okay, there's some rules. I can't go over them all here. No double dipping with the same wages for a PPP. So when you did your PPP, hopefully your accountant knew about the ERC, and you'll take rent before you take wages, or you'll take a portion of people's wages so you get the other portion for ERC. It has to be coordinated. If on your PPP you got a $100,000 loan and you submitted $150,000 worth of expenses, you kind of have to go back in your head and say, okay, well, let me pick and choose what portion of that 150 do I take to not interfere with my employee retention credit. So there is a coordination needed between them. And the rules keep changing. No owners get reimbursed for ERC. Did anybody, show of hands, did anybody here know that in their forgiveness application to PPP, they had to be considerate to leave open for this? One in the back. This program was available when the PPP forgiveness applications came out, because they came out much after. So when we did PPP forgiveness applications, we very selectively gave expenses so that those expenses wouldn't be double dipped for ERC. And so some people just said, well, I borrowed $100,000, my payroll was $200,000, I'll just submit payroll. Well, that was a mistake. You should have submitted your rent and your utilities and your leases and less payroll, so you have more payroll available for ERC. It's not too late to fix some of these things. Show of hands, whose accountants help them with their PPP? Very few. Those with your hands down, why are you still using that accountant? Okay, brand new. A show of hands, help me out. Who here is in a state where you pay income tax? Half. Okay, I wish I were, but I'm not. Trump's tax reform. Now remember, I'm from a high tax metropolitan area that seems to think the more tax you pay, the better. Trump made two major changes to personal tax returns that impacts how much tax you pay. He lowered the rates. Yay, we're all saving money. But he also took away our state and local tax deduction. So in general, my clients paid more tax. I think there's some politics here. I think he did the big F you to the big blue states where he was never going to get any votes anyway. And there's a reasonable argument here, by the way. Why should someone in New Jersey earning $100,000 a year pay less tax than someone in Florida earning $100,000 a year? The counter argument is because people in New Jersey get back only 40 or 50% of what they pay to the federal government, while people in Florida get 120% back. Because you need to earn more to have the same standard of living as you do in Kansas or in other places. So those two disconnected things always went hand in hand, and then Trump took it away, and it probably didn't hurt him politically. Every state is different. Connecticut came out with a law that said, if you own a business, we're going to tax your business, and then when you prepare your personal return, we'll give you a credit for the taxes your business paid. The business gets a deduction for it. If you have a rental property and you paid $50,000 of real estate taxes, you can deduct it all. There's no limit in businesses. Every state, most states have followed suit, and most states now allow this. But here's where the entity planning comes into play. As a partnership, all of my profit is eligible for this SALT deduction. So Joe Biden would have gotten a big deduction. If I'm a C Corp, I probably wouldn't get any of it, is the problem. Every state is different. Trump put something in place very nice called qualified business. I'm sorry, I can't see you that far. You're telling me to wrap it up quicker. Okay. He put in something where you only pay tax on 80% of your profit if you plan it properly. So in Joe Biden's case, $4.7 million, he could potentially get a 20% deduction on that, called qualified business income deduction. I keep pushing the wrong button. There are lots of rules here. If your income goes over a certain amount, you begin to lose this deduction, and then it's based on your payroll and your sales and your net profit. It takes planning. It is very complicated, and it depends on your situation. This topic needs to be brought up. These topics, QBI, qualified business income, needs to be brought up. The SALT workaround needs to be brought up. Employee retention credit needs to be brought up. Since I'm short on time, this is a common strategy. And by the way, these other things I talked about, what's special about them, which I should have mentioned, is normally we pay tax on our net profit, and it's just a matter of when we pay tax on it. And if you want more deductions, I always offer to raise my fees, and no one's ever taken me up on it. But those deductions are like out of thin air. Other things we do, and the most common is we work around what's your bracket now, what's your bracket later, and people have magic numbers. My income is normally $200,000. Some people leveling it out over years is good. Other people going way up and way down, they save more money. It depends on them. At $250,000, we start paying the Obamacare taxes. At a certain dollar amount, we start paying higher Medicare premiums. The 12% bracket goes up to $140,000. You can have tax if all you have are capital gains. You can have $80,000 of income and pay no tax. So everybody has these magic sections, I call them tax breakpoints, that you need to fill up. You need to think beyond yourself and think about if you have kids. Pay your kid $12,000. They don't pay any tax. You have a kid in college, give them your capital gains and let them pay their own tuition, and they get a credit for being in college. Don't pay tax on that. We have college kids with $25,000 and $30,000 of income that pay no tax. That income, which would have been on their parents' returns. We have clients that have a great year, but they have no money. They make a huge pension contribution and take it out the next year. It's actually the next day because they have until April to make it. They make it in April, they take it out the next day. But we now shifted income from year 1 to year 2. That might work. Sometimes it's the opposite. Client has a terrible year. We have them do what's called a Roth conversion. We have them pay the tax on their retirement account. Fill up all those lower brackets. What's heartbreaking to me as an accountant is being able to have reported more income without paying tax, or only 12% tax. It depends. If you're very successful in retirement, you're going to pay 40%. So if you could pay tax today at 12% on your retirement account, shouldn't you do that now? That takes planning. That has to be done this time of year. Taxes are really one of your largest costs. Really think about them all year long. Talk to your tax professional. Be proactive and be ready to pivot if they suck. Don't take it. You're worth more. Don't get in the groove of repeating last year. Here's immediate topics to go over with your accountant. Am I in the right entity? Do I qualify for employee retention credit? Does my state have a SALT deduction? Am I maxing my QBI? If they don't know what QBI is, just move on. Everyone has at least one tax point by which they should be shifting income. Ask them what that is for you. Ask them if they ever thought about it. Be proactive and not reactive. You have 1 month to get it done, and it's really up to you.
We have 2 questions that were submitted on the app. So I'm going to say the first one. How many times a year should we send financial reports to our accountant?
5. I believe your accountant should review your information after each quarter, and there's compliance things we look for as well. Are you paying people as independent contractors that should be employees? Are you paying your sales tax right? After each quarter, and one extra time around Thanksgiving or right before Thanksgiving to plan for the year end. How should we end this year? Remember, 2 + 2 doesn't have to equal 4. So that's the 5th visit.
And then the next question on the app is regarding electronic files. Do you just create folders or do you have a good system?
We actually do this for our clients, and they have access to it online so they can download it for them. And so, look, we have a folder for accounting work papers, which would be, their bank recs and their bank statements. We have a separate one for payroll, and we have a separate one for sales tax. But, having it is the key. You can worry about organizing it, but you have to have it. Okay. Thank you, everybody. Thank you for supporting Floor Force.